Okay, we're going to continue chapter 14 today. We have a few sections, two more sections of chapter 14, and then we're just going to cover to the third section. The fourth, non-cash activities, we're going to briefly cover this, and then we're going to do a brief review on final exam. Right, so chapter 14, we covered up to operating activities the other day, last week. Operating activities and cash flows. Again, the purpose of statement of cash flows is to capture all the activities that relates to cash inflow, cash outflow, and we're just going to break it down into different categories. Okay, so in terms of the entire statement of cash flows, it incorporates three main sections. We have operating activities cash flows, anything that relates to income statement accounts and current asset inflow, outflow, current liabilities inflow, outflow goes into the first section. Okay, so there are three main parts of statement of cash flows: operating activities, investing activities, and financing activities. So today we'll be going over a little bit of each and every section's examples, so you know how to input cash inflow information, how to input also cash outflow information. Again, the key point here is that anything that has nothing to do with cash do not go into this statement. Okay? Anything that has nothing to do with cash inflow and outflow do not go into this statement at all. So when we start this entire statement, we usually start adjusting cash inflow, outflow amount from net income. But keep in mind that net income sometimes incorporates a part of sales. For example, sales on account goes into sales revenue, goes into net income, but it has nothing to do with cash sales. So we're going to tease out some part of net income that has nothing to do with cash, and then add in the part that we did not consider in net income that has something related to cash amount. Okay, so operating activities, in summary, these bullet points are just examples. Okay, it's not the entire set of cash inflow, outflow activities. There's many different activities going on in the business. You don't have to know them all. You just have to know when each and every problem gives you a few activities, what are the ones that falls into which section. Okay, so anything that relates to sales revenue, if it's cash sales, if it's, for example, reducing accounts receivables based on collecting earlier sales on account, anything that relates to current asset, short-term asset, current liabilities, if we pay off current liabilities, short-term notes, those are the things that will go into operating activities section. Okay, later we'll do an exercise on classification of some of the activities. So anything that affects net income on the income statement, if it affects cash inflow, anything that affects current asset, current liability, those activities, cash amount, inflow, outflow, goes into operating section of statement of cash flows. Okay, this part in this entire chapter is very important. We're going to go into more details in this part. Throughout the entire chapter, the entire statement here, operating activities, this section, it will be most important for you to review on final. Okay, this part is relatively harder, this entire section, operating activities, compared to investing and financing. Okay, because this part is more complicated, you have to get this part right. This is the most important part and more difficult compared to the other two. Okay, now the last bullet point here, gains and losses on equipment trading. Later when we go into examples, you will notice that this part, remember this is usually listed at the very bottom part of multi-step income statement. Any gains and losses that we receive based on trading assets. Remember earlier in chapter 9 we were comparing trading away book value with the cash that we're receiving, right? And then comparing whether there's gain and loss, which one has higher value than the other. But this part here, even though it's an income statement, later on we will tease out this part from operating activities because this really relates to long-term asset trading. So any gains and losses later on, we will exclude it from operating activities, and then that will be included in investing activities. Okay, so later when we go into examples, this last bullet point here, gains and losses on equipment trading, since it is related to equipment trading, it's a long-term asset activity. Later on in operating activities, we will list it there, but we will minus the gains, add back the losses. Okay, because gains earlier was added in net income. Losses was subtracted from net income. Later we will exclude them out because it relates to the second, investing activities. Okay, so investing activities really just relates to one section of balance sheet, just relates to long-term asset. So any cash amount that you use to purchase long-term asset, land, building, equipment, machinery, any asset that lasts longer than a year, those cash outflow, the dollar amount will go into investing activities section. Okay, as opposed to purchasing, we may also be selling long-term asset. So if we sell long-term asset, receive cash immediately, that cash amount again goes into investing activities. Okay, again, statement of cash flow is only about cash inflow, outflow. So in this section here, if we did any trading on long-term asset that we used cash, not by signing off notes, not by doing other type of asset trading, but we actually use up cash or receive cash, that dollar amount goes into the second section of investing activities. Okay, so examples, acquiring long-term asset, using up cash, selling long-term asset, we'll be receiving cash. If we loan out money, remember long-term notes receivables? Receivables are a type of asset. So if we borrow money to other company, long-term, if the money is not due longer than, the due date for the money is longer than a year, then that money that we borrowed out, the cash outflow also will be represented here under investing activities section. Okay, so as opposed to loaning out money, if we receive cash based on long-term notes receivables earlier that we borrowed out, this is also the part that we will add to investing activities. So if you really look at these bullet points here, these examples, the entire statement of the cash flows, we're just reusing information from income statement, from balance sheet. Okay, earlier we did an income statement, we do a summary of revenues and expenses, right? At the end we get to net income or net loss. In statement of retained earnings, we just move that net income, net loss, add beginning retained earnings, subtract any dividends, that will give us ending balance of retained earnings. Okay, I'm just doing a summary of what statement, each and every statement is about. Under balance sheet is the most comprehensive income financial statement. It includes asset section, liability, equity, and asset equals liability plus equity. And the entire statement of cash flows, we're comparing this year's balance sheet against last year's balance sheet to figure out any dollar amount differences, why is there differences, and specifically which activity did the company perform. So we're just looking at cash balance difference and trying to understand in terms of why is there, for example, a net balance increase, $20,000 of cash. Where did that cash come from? Did we actually collected more money from accounts receivables earlier or from notes receivables? Did we use up some money to purchase assets, so on and so forth? So we break down cash activities into three types. This is the whole purpose of statement of cash flows. Understanding the differences between this year's cash balance and last year's cash balance by breaking down activities that relates to cash into three categories. Okay, but we're just using any information that we summarized earlier in journal transaction and T accounts and balance sheets, just representing it in another way that everything that relates to cash goes into this statement. Okay, and the last section here, financing activities, relates to long-term liabilities and equity. So pretty much it's the right side of balance sheet. Any long-term liabilities, if we sign off a note, if we borrow money from others, then we definitely gain cash. This gain cash amount goes into this section. Okay, if company issued stock to others, definitely they collected external capital. That external capital goes into this section. Okay, as opposed to that, if we buy back some of the stock, treasury stock, remember in chapter 13 we talked about treasury stock, The amount we use for buying back treasury stock, that cash amount also goes into this statement, this section of statement of cash flows, financing activities. Okay, so pretty much anything related to cash inflow, outflow that has something to do with long-term liabilities, something to do with any type of equity account goes into this section. Issuing stock? Yeah. Issuing stock is under equity. So from balance sheet, you would see if we compare this year's balance sheet with last year's balance sheet, let's say this year's equity common stock is 20,000. Last year, if there were 10,000, that means the 10,000 differences is the additional stock that we issue to the public. We collected $10,000 more cash. So that difference, 10,000, goes into financing activity section of statement of cash flows. Okay. Okay, let's take a look at the entire statement of cash flow, just to glance what it looks like. So the upper part relates to all the operating activities cash flows. Okay, see I put a red arrow there? We would start from always net income under the indirect method of statement of cash flows. Okay, so we're only going to be going over indirect statement of cash flows method. This is actually most popular in the business world. So we would start from net income and then try to tease out the part that's included in net income, revenue and expenses, but it's not cash revenue, not cash expenses. Okay, remember, this all goes back to accrual accounting earlier in Chapter 3 when we talked about whenever a company provides services, once they performed it, even though they did not collect cash, we still record it as sales revenue, right, or service revenue. So some part of the revenue in that $40,000 net income is actually not cash collected yet, right? It could be accounts receivables. Okay, another example, so some of the expenses, remember sometimes we have utility payable or salary payable, but at the same time we still record salary expense, utility expense. So in that $40,000 there's some of the expenses that has been subtracted, but really it's not a cash expense. Okay, so if we start from net income, it's easier because the majority part of cash increase, cash outflow is already included there, but we still want to tease out some part that has nothing to do with cash increase and cash decrease, specifically the parts on accounts. Okay, sales on account, purchase assets on account, anything that relates to accounts receivables, accounts payables will need to be excluded from that $40,000. Okay, so we're going to go into examples later. I just want to show you what an entire statement of cash flow looks like. So the middle part, we have investing activities, any cash that company used to purchase long-term asset, any cash that they received from selling long-term asset goes into the middle section. Now, financing activities, everything that relates to long-term liability could be collecting, paying off long-term notes payable, or borrowing money from signing off long-term notes. You could be issuing stock or buying back stock. Any cash increase, cash decrease goes into the third section. So if we just look at the right column there, the net effect for all three categories, we have operating activities, the subtotal there is $70,000. Middle part, investing activities, you see a bracket, $260,000. That basically means the net cash effect for anything that relates to long-term asset purchase or selling, we lost cash $260,000. Okay, the first $70,000 operating activities, anything that relates to daily operations, revenue, expenses, we gained cash $70,000. Investing, overall, we lost cash $260,000 in terms of anything that relates to long-term asset purchase or selling. And this part here, long-term liability and equity, we gained cash overall by adding all the long-term liability equity activities. We gained $170,000 in investing activities. So if we add those three numbers up, 70,000 plus 170,000 minus 260,000, overall this will tell you the cash effect is minus $20,000. Meaning that if we compare last year's cash balance with this year's balance sheet, you'll figure out this year's balance sheet cash balance reduced $20,000 compared to last year's. Okay, so overall this year's cash balance is $22,000. We got this from the net cash effect plus anything that you got at the end of last year. Add them up, that will give you this year's cash balance. And this should equal balance sheet asset category cash balance. Okay, again, the whole purpose of this is to understand, if we look at last year's balance sheet, you will see cash balance $42,000. It tells you here it's December 31st, 2013's cash balance. If we look at this year's cash balance, assuming this year is 2014, you will find $22,000. So the difference is here, the minus 20,000, we actually already know this by comparing last year's balance sheet and this year's balance sheet. Throughout this entire statement, we want to know why is there a minus 20,000 here. And we break that down into three categories, into operating cash flow, investing cash flow, and financing cash flow. Okay, so this is the whole purpose of the entire statement, is to understand why is there differences between last year's cash balance and this year's, the minus 20,000. It comes from these three activities. So for the most part, we lost a lot of the cash by purchasing long-term asset. If you look at the bracket 260 there, if you look at this entire middle section, acquisition of plant asset, we spent $310,000. That's a significant amount of cash loss compared to other activities. Right? Other operating, we gained $70,000. Equity, we did pretty well because we gained $170,000. There's a lot of cash here. Okay, so this entire statement will tell us specifically which area in the business the company has been using a lot of cash, which area they have actually gained a lot of cash inflow. Questions? No? Okay, let's take a look at how do we do the first section here. Okay, before we go on to that, there's also other activities, non-cash activities. I just want to briefly mention this. This is not a majority part of the entire statement. But sometimes below the statement, after we list the end cash balance here, after this section here, sometimes there's also a section that tells you all the non-cash investing and equity activities. Basically, these are activities that are major but has nothing to do with cash inflow and outflow. But we still sometimes in companies has a section to report these. So for example, if we acquire a building, we purchase a building, but at the same time we didn't pay cash, we didn't sign long-term notes, but by issuing common stock to the other party. So making the other company part of our company's investor. This sometimes happens. Okay, so these are some of the infrequent activities, but sometimes since the dollar amount is very significant and it has nothing to do with cash, but we still list it as like a memo in the statement of cash flows activities right at the bottom. Okay, so these are what we call non-cash investing and financing activities. Anything that relates to long-term liability, equity, but has nothing to do with cash sometimes is reported here as a note underneath all the cash activities. Okay, other examples, again, you may be acquiring land from another company, but you didn't pay cash immediately. You sign a long-term note. So in that case today, if my company is the purchaser side, I'm not paying any cash out today by purchasing that piece of land. I sign a long-term note. Perhaps it's due 10 years from now or 5 years from now. Okay, but this is a major activity that relates to investing and financing, so sometimes it's also listed in the bottom of statement of cash flows. Okay, this is actually in the fourth section of this chapter. I just moved it ahead. You just need to know that the idea that sometimes when you look at a statement of cash flows, it has some of the non-cash activities. Okay, you don't have to memorize all of them. Basically, all these activities, the easiest way to understand this is when you look at an activity that happened, if it has nothing to do with cash debit or cash credit, it falls into non-cash financing and equity, investing and financing activities. Okay, if it's a long-term liability related, equity related activity, but you see from the description, you wouldn't need to debit cash or credit cash, and it falls into this section. Okay, that's all to it. Okay, let's do the very quick classification together. You see A through J, these different activities. If I were asking you to categorize these into operating, investing, financing, these three types, which one would you call A? A would be in operating activities because accounts payable is a short-term liability account, right? Okay, what about B? Payment of cash dividends. Guess again. What is dividend? Dividend is related to, I should say, what is dividend related to? Why is company giving out dividend? Why is company? They issue stock before, and they are rewarding shareholders. So what is stock? The type of financing activity. Okay, so cash dividends, the payments there, anything related to stock, buying back the stock, issuing the stock, long-term liability and equity all goes into financing activities. Okay, dividends is a way to reward shareholders. So very good, yes, it's part of financing activities. Okay, what about C? Decrease in accrued liabilities. Very good. It's operating activities. What about D? D, financing activities. Good. Gain on sale of building. This, when you see this on statement of cash flows, these two are the tricky ones, E and F. E and F, gains and losses, is part of income statement, which is why it would be listed here in operating activities. However, we would usually exclude. The purpose listing in there is we're taking it off from net income. So we would minus gain plus sale. Later on, the total amount will be reported here. Okay, but in terms of listing it, it's still part of operating activities because those are income statement categories. Gains and losses you will see in multi-step income statement in the very last section, the other revenue, other expenses. So anything that you see on income statement is still part of operating activities. Okay, depreciation expense. Operating because it's part of income statement. Increase in inventory. What is inventory? Inventory is a short-term or long-term? Is inventory long-term? That company purchased it in, you sell it 10 years later? Okay, where do you see inventory in the balance sheet? Chapter 5 and 6. I'll give it back to me. Chapter 5 and 6, inventory. Inventory is part of a current asset. Right, for merchandise or company, inventory, when we purchase it in, it's very important to sell it to your target customer as soon as possible. Remember, inventory turnover rate. We always want companies to purchase in from inventory from their supplier and immediately or as soon as possible resell it to your customer to gain the gross profit in between. Remember? So inventory is always a current asset account because we want to sell it immediately within a season or within an accounting cycle. So any increase, the money that you spend on purchasing inventory will be reported under operating activities. These are part of the daily business activities, day-to-day transactions. So anything listed on operating activities is actually the frequent transactions that you see on a daily basis. Okay, accounts receivables decrease. Operating accounts receivables is part of current asset. It's listed very close to inventory. Purchase of equipment, investing. This is a long-term asset activity. Okay, any questions on this? Categorization of this chapter is very important. Which activity belongs to which section? This is important to know before you do any calculation. You have to know where it's reported first, otherwise you will get this section's cash flow wrong. Okay, so categorization is very important in this exercise here. Okay, let's move on. How do we prepare statement of cash flow in an indirect method? In terms of exams, I would not ask you to actually do one. We're going to do one exercise in class later, but if I give you a statement of cash flow, I'll give you part of it, you have to know what it means. Okay, I will not actually ask you to do one from scratch. I'm not going for that or any other types of statements. So if I present one or a part of the information for one section, to calculate just operating activities cash flow or investing activities cash flow or financing activities cash flow. Okay, so you have to know how to do the calculation part. So always in the operating activity section, this is just looking at the operating section, the first part of statement of cash flow. So we would start from net income and then do some adjustments to reconcile net income to the cash provided in this activity section. Okay, what this means is basically earlier what I mentioned, we want to tease out the part that has nothing to do with cash inflow, cash outflow. That's what it means by the adjustments line. Okay, so we will do this by adjusting some of the income statement accounts. Depreciation is always the first one to look for. Any depreciation amount you see on income statement, remember depreciation is really a measurement. We estimate, for example, a desk that could be used for 10 years, and we spread the cost along each and every year. The depreciation expense, really, company perspective, they're not paying any cash to anybody. They purchase the furniture, they spread the cost year by year, consider it as the usage expense, but it's not really a cash expense. Okay, so that depreciation was originally subtracted in the net income when we do the calculation. Remember, revenue minus expenses, we add back depreciation because it's not a cash expense, but it was subtracted in net income earlier. So we add that amount back, whatever the amount is. Okay, any depreciation, amortization expense, we will add it to net income earlier. It was subtracted, but it's not a cash expense. So we add it back. Now the idea of loss on sale of long-term assets, we're adding it back as well. Earlier it was subtracted from net income. We're adding it back just because later on the cash will be representing it under investing activities. Okay, so we're adding back loss, subtracting any gain on sale of planned asset. Those two just because later it will be represented in the second section. Now in terms of balance sheet, this I'll go into more details later. Any increase in current asset other than cash increase, meaning if there is accounts receivable, we compare to last year's balance, any increase, we will subtract it from net income. Any decrease in current asset, we will add it back. Okay, a simple example to memorize here is you can think about accounts receivables. If you think about accounts receivables, last year's balance was $5,000. Let's say this year's balance is $10,000. If there were an increase in accounts receivable, this is a current asset other than cash, accounts receivable represent cash collection later on. So any increase in this category does not affect, it's reported in sales revenue, but it's not really a cash revenue. Okay, so this increase in current assets, just immediately think of the example of accounts receivables. Increase in accounts receivables increases sales revenue, but it's not a cash sales revenue. Okay, so any amount there, we would subtract it from net income. Because within net income, there's a part of sales revenue that's incorporated in it, but it's not cash sales revenue. Okay, the same example works for decreases in current assets. Decreases in accounts receivables, that basically means you collected some of the cash on account. So we add that amount that we collected. Okay, so it's the opposite of increase in current assets. Now, current liabilities is more straightforward. If we have a decrease in current liabilities, if you think about accounts payable, last year's balance is $5,000, this year is $1,000. You have a decrease in accounts payable, the $4,000, that basically means you paid off the cash. So any decrease in current liabilities, think of the example of accounts payable. The deduction part, we subtract cash flow amount because that's the amount we actually paid off, clear the liability. So as opposed to that increase in current liabilities, oftentimes accounts payable increase. The journal entry, the other side, might be increasing inventory or increasing a type of utility expense or different type of expenses. That amount that increased there was subtracted earlier from the expenses, but it's not a cash expense, so we add it back. Okay, I'm going to go into this in more details later. Let's take a look again at income statement. So income statement, if the problem gives you one, just pick gain on sale of plant asset and also any depreciation to adjust net income amount. Okay, remember depreciation is not cash expense, so we add it back. Gain on sale of plant asset, we will be reporting it in the second section, so that part we subtracted from net income. So if we start from net income here, we would have $40,000 as the first line of statement of cash flow. And then we would add depreciation expense, which is $20,000. Gain on sale of plant asset, we subtract it. Okay, up to this point, this is what will be represented in statement of cash flow. We start from net income, add back depreciation. This is not a cash expense. Subtract gains on sale of plant asset, and if there's losses, we would add back losses, just so it can be represented here. When we get to the second section, you'll know what I mean. So anything that relates to plant asset will be reported here when we talk about cash that we paid for long-term asset. So if we don't subtract it, it will be duplicated here. Basically, that's what it means. Okay? Okay, now for balance sheet categories, as I mentioned earlier, current asset, think of the example of accounts receivables. Increase meaning if we compare current asset balance with last year's balance. Think of the example accounts receivables. If last year is $5,000, this year is $10,000. The increase $5,000. At the same time, think of increasing sales revenue by $5,000. Okay, so journal entry accounts receivable, if it increases the right side, definitely there's a type of revenue, service revenue or sales revenue increase. So if this part compared to last year, there was $5,000 differences, that means sales revenue, there's incorporated $5,000 of non-cash revenue. Okay, so any increase in current asset other than cash, we would subtract this $5,000 because statement of cash flow, we just want cash. So we don't want the net income part that has nothing to do with cash. Okay, as opposed to that, if we have a decreased current asset, if we collected accounts receivables, last year's balance is $10,000, this year is $5,000. The difference, $5,000 of accounts receivables decrease, think of it as collecting accounts receivables. So the $5,000, we would add it if current asset decrease. Okay, for liabilities, if we increase current liabilities, meaning last year's current liability was $5,000, this year is $10,000. The difference is in increasing current liabilities. At the same time, the left side will be some type of expenses increase. So the amount of expenses was already subtracted in net income. We want to add it back. Okay, so current liabilities, accrued salary expense is an example that I give you. If last season compared to this season, current asset increase, that's the part, the current liability increase, that's the part that expenses was already subtracted in net income, so we want to add it back. The other example, if current liabilities decrease compared to last year, think of it as paying off accounts payable. So if you pay off liability, you definitely use up the cash, so we subtract that dollar amount. Okay, if we take a look at the comparative balance sheet, the upper part you see current assets differences. So this year's balance is $90,000. Last year is $73,000. So there's a $17,000 increase in accounts receivables. This is the part that we think of it as. The other side, there's increase in sales revenue or service revenue that has nothing to do with cash sales or cash service revenue. So the $17,000 later was subtracted in the statement of cash flows. Okay, so earlier we had depreciation, we added back, gains we subtracted, and here the $17,000 of accounts receivable increase, we will subtract $17,000. Okay, if we move on to inventory last year ends 145, this year is 143. The $2,000 of current asset decrease, we will add back the $2,000. Any current asset increase compared to last year, under cash flow, we would subtract it. Under current asset decrease, we would add it back. So the direction is opposites. Okay, just think of the example of accounts receivable. That's the easiest one. Last year, accounts receivable balance is lower than this year. That means this year you made more sales on account or service revenue on account. So those on account one is the part that we want to tease out from net income. So that's the part that has nothing to do with cash. Okay, the accounts current asset increase part, if we compare a certain account compared to last year, current asset increase, think of the idea as basically accounts receivable again. If we have additional accounts receivables, if we have lower accounts receivable compared to last year, that basically means we collected some of the money. Okay, so we will add that $2,000. Okay, if we look at accounts payable, last year $50,000, this year $90,000. Accounts payable increase, that means we had something that we purchased on account or some of the expenses that we listed as accounts payable. We didn't actually pay it off. Okay, so an increase in current liabilities, we will add that $40,000. So think of the idea of certain type of expense. For example, utility expense. It was subtracted in net income, but it's not a cash expense yet, so we add that $40,000. Okay, accrued liabilities. Last year is $10,000. This year is $5,000. So the difference is $5,000 current liability decrease. Basically means you use up the cash to pay off the liabilities. That's why your liability account reduced. So cash dollar amount here, it was subtracted. Oh, sorry. I mean, it should be the 2,000. Why is it the what?
Inventory balance.
Because last year end balance is 145, this year's balance is 143. So the right side column is all the net differences. Okay? So for accounts receivables, this year is 70, last year is 73, this year is 90. Net difference is 17,000 up. Increase in that account. Okay, so any current asset increase, just think of the example of accounts receivables. Other examples sometimes is harder to understand. Any current asset increase, accounts receivable increase, sales revenue increase. But sales revenue is incorporated in net income, which that part has nothing to do with cash, so that's why we subtract the, I'm sorry, where it is. Well, the bracket is around the 17,000, sorry. This part here is around 17,000. Any current asset increase we will subtract in cash flows. Okay, because current asset increase at the same time sales revenue or service revenue increase, and this is not cash sales. So the direction of asset increase and decrease is opposite direction toward cash flow increase and decrease. Okay, so the blue arrow there is the cash flow effect. Yes.
So the 17,000 is actually
Subtracted in statement of cash flows.
with brackets around that?
Yes. And then inventory, overall the effect inventory is deducted from compared to last year. So this is another account other than cash that's current asset. So current asset decrease, think about the accounts receivable example again. If we decrease accounts receivable, that basically means we collected cash, right? So any decrease in current asset, we added to statement of cash flows. Okay, once again, for liabilities, it's more straightforward. Liability, think about accounts payable. If accounts payable compared to last year decrease, that basically means we paid off some of the accounts payable. So any decrease amount, we also have a bracket around it, 5,000. Any increase in liability, we would add to statement of cash flows. Okay, because increase in liability, at the same time, certain type of expense is increased while you journalize it. This expense was subtracted here, but has nothing to do with cash expense. So this part, we added back, the $40,000. Okay, if we put the balance sheet account and income statements all together, it will look like this. Okay, again, we start from net income, we add depreciation, gain, or if there was losses, we also add back all the losses. And then accounts receivables, inventory, overall the effect that I just wrote there on the whiteboard. Overall effect by comparing the 2 years balance sheet will be listed here on the statement of cash flow that looks like this. Okay, so we'll have a net effect $70,000 increase in cash. So we're starting from 40,000 net income and adjust the part that has nothing to do with cash, tease it out. Overall, the effects of daily operations, we gain cash compared to last year, $70,000. Okay, let's take a look at the investing activities. So the second section, investing activities, relates to only 2 types. Any cash that we received from selling plant asset and any cash that we paid off by acquiring long-term asset. So anything that falls under like furniture, equipment, machinery, the cash that we used to purchase it will be subtracted in statement of cash flow, because this is using up the cash to purchase long-term asset. Any cash that we collected based on selling plant asset will be added to this section. Okay, so basically it only has 2 types. Just the part that we received on long-term asset based on selling it, and the cash that we used up when we actually purchased new long-term asset. Now the reason why earlier we teased out the gains and losses is because gains and losses appeared when we compare the cash we received from long-term asset and the book value of the old asset. Remember in chapter 9? We talked about collecting, for example, collecting $10,000 from selling an asset when the asset only worth $9,000. So the difference is 1,000 is the gain that we talked about earlier. Or if we flip the example, it will be a loss. Any gain and loss really is already incorporated in cash receipt when we sell the planned asset. Okay, it's just the middle part of cash receipt. Cash receipt, a portion is book value plus any gain, or book value minus any losses. So if we didn't tease out this part here, it will be appeared again in this middle section, and we have a duplicate transaction there. Okay, so investing activities, we have cash receipts, dollar amounts, and any cash payment that we use to purchase long-term asset. Okay, this part here, just to refresh your memory in chapter 9, cash receipts on long-term asset. And cash receipt comes from, usually earlier in chapter 9, the problem directly tell you what is the cash receipt. We're getting $20,000 from this trading transaction, or $10,000. And then we try to figure out what is gain and losses. But really, if we move backwards, if we know our long-term asset, or our asset only worth, for example, book value $9,000, and we know this transaction we had to gain 1,000, then we know cash receipt is $10,000. Okay, or if book value of asset worth 9,000 and loss on sale $1,000, then that means cash receipt is 8,000. Okay, the formula here in chapter 9 we didn't state it this way, but really this is what it means in chapter 9. And when we trade and sell planned assets, we compare book value with cash receipt to determine any gains and losses. But here, since when we do statement of cash flows, we already have income statement, we have retained earnings, we have balance sheet there already. We just look at gains and losses and the book value of old asset, add them together, that will give you cash receipt. And cash receipt is our goal to represent in statement of cash flows. Okay, so let's take a look at just an example. So for the problems here that you will see in this chapter, oftentimes they will tell you a little bit of other information and ask you, for example, the question mark here, or then later ask you what is the cash that the company actually used to purchase the asset, or what is the cash that the company received from selling the asset. So some of the problems here really is just kind of solving this formula here, which you already know in chapter 9. Okay, beginning planned asset plus any new purchases minus depreciation will give you ending planned assets value. This is just the idea of how T account work for assets. Okay, so here's an example that planned assets, you see the left side. The beginning balance is $210,000. That's from last year end. And this, let's say this company did additional purchases, $310,000. That's the new purchases of assets this year. Let's say the depreciation overall of the long-term asset worth $20,000. $20,000 is the part that grown old, depreciation. And it tells you ending balance here is $460,000. By giving you all these information, the question mark there basically is what is the book value worth for this year, the book value of the asset that has been sold out. Okay, beginning plus new purchases minus depreciation and anything sold will give you the ending balance for this year. So if we just solve this equation, it's actually very simple. The part that we sell out, the book value worth $40,000. Again, the beginning balance of long-term assets is $210,000. We made new purchases. Some part of the long-term asset as time goes by grown old. And then some part, the question mark there is the part that we sold out to others, book value of the asset that we sold out. Eventually the balance is $460,000. And if the problem asks you what is the cash that they actually received from selling that question mark asset, We first need to figure out what is the book value of the asset here, and then match it with income statement gains and losses to figure out what is the cash receipts. Okay, so income statement, if we look at gains and losses section, if it tells you the gain is $10,000, then you know for a fact that book value $40,000 plus any gains that you see on income statement will give you the $50,000 cash increase. This is the part that we sell to others, that we collected cash from others. Okay, this slide here tells you the question mark is the book value of the asset. Once you know the book value of the asset that's sold out, then any gains and losses, just add the gains or subtract the losses. That will give you cash receipts of that selling transaction. Okay, so if this were another example here, if the $10,000 is losses that you see on income statement, and let's say the book value of the plant asset is still $40,000, then cash received will be $40,000 minus $10,000. Cash received overall you see on statement of cash flows will be $40,000. Okay, will be, I'm sorry, $30,000. $40,000 minus $10,000. Okay, this is an example of the gain. If you see gain on income statement, that basically means when we sell the asset, we got more than what the asset worth. That's why we have a gain. So if we want to move backwards to find cash increase, that would be $40,000 plus $10,000 gain. So this is an example of a loss. That means that we collected cash less than what the book value of the asset worth. So it would be $40,000 minus $10,000, $30,000 of cash increase. Okay, other problems may give you beginning balance, give you the book value, depreciation, ending balance, and ask you what is the dollar amount that we use to purchase asset, the $310,000. Then again, basically you just put in all the information here trying to find a question mark. Okay, the important part is you have to know beginning asset plus any new purchases minus depreciation minus anything sold will give you ending balance of an asset. And that pretty much is the logic for each and every T account. Right, left side, you add them up, minus right side to give you the left side balance. So if you know this, for all the questions here, it will be very easy because it will tell you 4 parts of it. You just figure out either book value sold or the acquisition part. Okay, so far what we talked about is the second part of the statement of cash flows. So if we move that $50,000 here, you see upper part operating income, and then you have operating cash flows. This part here you have long-term assets cash flows. You receive cash, $50,000, remember book value plus $10,000 gain, and then $310,000 acquisition. The problem in the textbook, if you read the example, it directly gave you this number. Okay, so if you know for a fact the problem gives you this, just subtract $310,000. That's the cash the company used up to purchase long-term asset. Okay, for financing activities, the last part here, all of these relates to either issuing stock, which is gaining cash, or buying back stock, treasury stock, losing cash, or signing off long-term notes, borrowing money, gaining cash again, or paying off long-term notes. You'll be losing cash if you pay off liability. or payment of dividends, losing cash. So this section relatively is more straightforward too, because any plus and minus doesn't have opposite defects compared to operating activities. Basically, any payments you subtracted, any cash received you added. Okay, only the first section, operating income, we're moving backwards from net income. All the other section, if the problem tells you that a company paid liability, then definitely reduce cash. If they sign off long-term notes, borrow money, then increase cash. Okay, if they issue stock, also increase cash. Buy back the stock, loses cash. Okay, first example, if we look at long-term notes payable. Does long-term notes payable increase or decrease here compared to 2 years? Well, if last year is 2013, this year is 2014, what happened to the balance? We had an increase in liability for the $80,000, right? So what does that $80,000 mean? Did we pay it off or did we borrow more? We borrow more. If liability account, if it increased, that basically means that's the net effect of borrowing and paying, but overall the effect is we borrow more than what we paid. Okay, so that $80,000 here, if we look at the T accounts, again, like solving the equation, right side of the liability tells you beginning balance is 80, tells you we borrow more money, $90,000. Overall, the effect, 80 and 160, the balance difference is 80,000. But really, notes pay off. Assuming that the problem tells you all three information here, then you'll be able to figure out what is the payment of notes, $10,000. Okay, so you have the beginning balance, the ending balance, so the problem tells you the new notes that we issued this year are really worth $90,000. Then you know there's $10,000 missing in this entire T account. So overall, what you would see on statement of cash flow is new notes issued plus cash 90,000 minus cash 10,000 for any notes that we paid off. Okay, from investing section and financing sections, all the problems pretty much will tell you a T account, an incomplete T account. Tells you some of the information you just need to figure out based on ending balance, beginning balance. What is the blue number here? Or probably what is the new notes that we issued? And then these two will be the dollar amount listed on statement of cash flow. New notes issued, we borrow $90,000, cash increased $90,000. Notes payments, we paid off $10,000, so cash decreased $10,000. Okay, for stock issuance, we have either purchased common stock or treasury stock. Now, common stock account here, you can tell me is there increase or decrease in the account? What is the balance effect? Is it increase? Has it increased from last year or decrease? Common stock. Increase 120,000. What does that mean? If we issue more stock, how does it affect cash? Cash goes up 120,000, right? So for common stock here, what you see on statement of cash flows, you would see a cash increase 120,000 just by comparing balance sheet. Okay, common stock, basically, we don't decrease that account. If we decrease it, we will separate it in treasury stock when we buy back some of the stock. Okay, common stock, any effect there, basically, Other than treasury stock or retirement, which we didn't talk about in this class, you just need to find the differences, and it's purely cash increase. Retirement is canceling some of the stock. Sometimes company buys it back and they state that they're never going to resell it into the market. So that's a retirement, usually for preferred stock. Okay, but we didn't go into a lot of details because preferred stock has a lot of benefits. So sometimes when they retire the stock, they no longer want to issue preferred stock to shareholders. They may buy it back and then never resell it out. That's the retirement of the stock. Okay, now for treasury stock, if you see treasury stock listed, that basically means company used up cash to purchase their stock. So any dollar amount differences, last year if it's zero, this year is $20,000 balance, that means cash went down $20,000. Okay, so treasury stock minus $20,000 will be listed on statement of cash flows. Okay, dividends we can figure it out from retained earnings balance difference. Okay, what goes into statement of retained earnings? Besides the beginning balance of retained earnings, what else? We will add net income and minus any dividends to get to final balance of retained earnings, right? So beginning balance and ending balance of retained earnings here, the $30,000 may be completely just net income. It may be perhaps after subtracting some part of dividends already. We don't know. So we look at income statement to figure out what is net income, and then we can figure out what is the part of dividends declared. Okay, all of these information is also in T accounts transactions. I'm going through an approach just telling you if you just look at the statements, how do we figure out dividends? We look at net income statement, it will tell you $40,000. Then you know retained earnings balance difference, there's still $10,000 that company gave out to others. Meaning if company did not give out dividends, the balances difference listed here should have been $40,000. Okay, but if it's only 30, that means a part of the dividends goes into, a part of the net income is issued out as dividends to others. So we subtract $10,000, this is the cash dividends part. For example, figure out, yes, if I didn't give you this part and the problem I tell you what is the beginning balance, retained earnings, ending balance, net income, is there any dividends gave out and how does it affect statement of cash flow? So in this case, there's $10,000 that gave out to shareholders and this $10,000 reduces statement of cash flow, so we subtract $10,000. Okay, similar for these cases here. Treasury stock, if you see it on balance sheet, that basically means we use up our cash to purchase stock. So statement of cash flow, you see a negative $20,000. Okay. So if you look at the entire cash flow statement, the last section here, you see the difference is $120,000 is the cash gain from issuing common stock. $90,000 is the cash gain based on borrowing money. $10,000 is based on paying notes payable, so we reduce $10,000. $20,000 is the cash we use to purchase treasury stock, and $10,000 is additional dividends that we gave out to shareholders. So overall the effect, because we actually issued a lot of common stock, 120, the effect is still positive, 170,000. We have increased 170,000 in the investing activity section. Okay, so overall the net increase or decrease, if we add three sections together, we have a negative 20,000. Again, that's because the majority part of the cash we lost in purchasing long-term assets, 310,000. Okay, so this $20,000 is the balance of net decrease in cash. If we add it to last year's balance, this will give us this year's cash balance that you see on balance sheet. So this part here, the 22,000 should agree with balance sheet cash balance, $22,000. So this part here is not the same as balance sheet. That basically means this part there's something that went wrong. You didn't do right. This 20,000, you will see it exactly the same as this year's balance sheet cash balance. Okay, so last part here, net changes, I just enlarged it a little bit. Net changes in cash operating, 70,000 minus the investing activities. Overall, we lost 260,000, and plus any financing activities cash flow will give you the last part here, net cash decrease, $20,000. That's the major part that we want to get to. So why is there cash effect? The majority part, we lost a lot in the middle, investing activities, and we gained a lot in financing, investing activities. Financing activities, I'm sorry. We just add the right side. The balance is up. The operating 70,000 minus 260,000 plus 170,000. Is that your question?
No, I was just thinking if you could just add the parentheses, and that will equal the cash.
Yes, that'll be the same. Let's work on an example here. Put this out. Okay, I'm gonna skip this. Okay, take a look at this question here. First of all, try to separate these into operating, financing, and investing activities and see if you can figure out whether we have to add the dollar amount or subtract the dollar amount in statement of cash flows. And you start from net income, 55,000. You add or subtract any operating activities, and then consider investing activities and then financing activities. If you're not sure, just think about the problem and I'll go over it with you in a minute. Okay, what are the operating activities here? How many of them? Three? Which one is the first one you will list? Depreciation, and specifically we would add it or subtract it? Add it. Add 20,000 to 55,000. What else? Increase in current asset other than cash, $14,000. We would decrease it, subtract 14,000. Very good. And decrease current liabilities, $19,000. Very good. So we have three categories of operating activities, and specifically we will list them on, I just highlighted them in red, the operating ones. And we have current assets, current liabilities, and also depreciation expense. Anything that relates to income statement, current asset, current liability, and balance sheet goes into operating activities. Okay, so in the statement it will look like this. The 55,000 is already listed there. Depreciation, you add it. Increase in current assets, subtract it. Think of the example of accounts receivables. If we have increased accounts receivables, sales revenue increase, but this is not cash, so we subtract it. Okay, decrease in current liabilities basically means we paid off some of the liabilities, so we use up the cash, so we subtract $19,000. So overall net cash provided by operating activities worth $42,000. Now the second section, investing activities, this relates to any long-term asset activities. So purchase of equipment, $39,000. Basically, if we purchase something, company's perspective, they'll be losing cash, $39,000. Now cash received from sale of land, the $34,000, it readily tells you it's a cash receipt. So we add the $34,000. Okay, so the investing section will look like this. We subtract $39,000, purchasing asset, it loses company's cash. Cash received as selling asset, $34,000. The last section, financing activities. If we issue common stock, this definitely, we raise capital from the public. This increases cash balance by $30,000. Any payment of dividends, $6,100. Any payment of dividends is always reduces cash. Okay, unless it's a stock dividend. If it's a stock dividend gave out, it has nothing to do with cash. Okay, but if it's regular, it doesn't tell you stock dividend, just say paid out dividends. Just assume it's cash dividends. So in this question here, investing activities overall, we also lost $5,000 cash. Financing activities increased $23,900 since we raised capital from common stock, $30,000. That's a lot more than the cash dividends that we gave out. In terms of operating activities, we increased $42,000 here.
Can you go back to the list?
Sure. In case you miss any part, all of these are on Blackboard, okay? So overall net increase in cash is $60,900, and then after this, usually there will be one line of last year's cash balance, add to $60,900, that will give you this year's cash balance. Okay, so this usually is not the end of the cash flow statement, this is just the overall effect.